personal finance. Now, before we begin, it is very important that I preface to you that this is not financial advice. I am not a financial advisor. If you are looking to make any financial decisions, it is important for you to do your own research and, whenever possible, speak with an accredited professional who knows what they're doing. Okay, so with that out of the way, let's have a conversation about credit cards, because I find myself in a position in my life now where I really need to start focusing on my own personal finance decisions, and I am just going to share with you some of my own research and give you some examples of how these systems operate. So, when we're talking about credit cards, let's say we have a man. We're going to draw him right here. This is our friend. This is Bob, okay? Now Bob here would like to open a line of credit, okay? Let's say Bob needs a loan for a car or a house or something, and he needs a line of credit. He doesn't have a credit history, anything like that, but he needs a credit score to prove that he, can operate a loan. So what Bob does is Bob's gonna go to the bank. We'll draw the bank right over here. This is our bank. Now, Bob is going to go to the bank and Bob's going to say, "Hi, I'd like to open a line of credit." But the bank doesn't know anything about Bob because Bob doesn't have a credit history. So the bank is going to say, "Hey, Bob, look, we understand, right? You want to open a line of credit, but we can't just give you the best, right? We can't just give you, the top of the line kind of stuff." So what the bank does, the bank says, "Hey, Bob, we'd like to give you a credit card with a low monthly limit," right? So let's say Bob goes to the bank. Bank says, "Here's a credit card, right? Here's a credit card right here. It's got Bob's name on it and a nice big number across the top. And this credit card here, let's say this credit card has a monthly limit of $300. Okay, so $300 on this credit card, and this is money that Bob can use for whatever he wants. Okay, sometimes certain creditors are going to limit what you can spend on, but those are usually, extreme circumstances. It doesn't happen very often, but it can, so it's important to be aware of that. But this is $300 that Bob can spend however he pleases every single month. But this money is not free, okay? This is not just a freebie. This is not just extra money that he's being generously offered. This $300 is a loan. Essentially, it's not, a loan in technical terms, but this $300 is the bank's money, okay? This is not Bob's money. This money comes from the bank, or it may come from a credit union or another type of lender. There are, various different ways to get credit. We're not going to go super in depth about what those are and all the different circumstances, because it gets very complicated very, very quickly. But let's say Bob takes this $300 and he uses it to just pay for necessities like gas or something. So that $300 is then money that he needs to pay back at the end of the month, depending on, of course, if he uses all 300, wherever the money goes, he doesn't have to use all of it. But over time of using this $300 and paying it back to the bank, that will increase his monthly limit, and it will also increase his credit score. Now, what is a credit score? A credit score is a number typically ranging between 300 and 850. So this is the credit score. And this number is essentially the creditor or the lender's ability to assign you a value that determines how risky you are. So it is really complicated, but essentially it's just a risk assessment score for the banks, and it tells them, how likely they think you are to pay your bill on time, to pay your debt on time. How likely they are to give you more money or more benefits or better cards, based on how risky they think you are as a user. So, one of the most important things if you're trying to build credit is to just pay your monthly credit card bill on time, right? There are all kinds of ways that you can, maximize your credit score and all these other things, but that is not the purpose of this video. That we're just here to explain that your credit score is essentially a risk. So that is essentially what that number is telling you, and of course, the lower the number, the worse it is, right? So, for example, and this is just for example purposes. Let's say Bob here is applying for his credit card, and Bob has a credit score of 691. So Bob goes to apply for a credit card, and the bank looks at 691 and says, okay, well, you're maybe not the best with your money. You're maybe not spending. You're maybe spending more than you can afford, or what have you. You've made some less than stellar financial decisions, but you're not super in the hole, right? You're not bottom of the barrel. Maybe you're working your credit up or what have you, but you're not the most optimal customer of this particular bank. Let's say we've got another man over here. This man's name is Tim. Let's say Tim has a credit score of 750. So the bank is going to look at these two numbers, and the bank is going to say, okay, well, Tim has a credit score of 750. We can give Tim some more money. We can give Tim, better benefits. One of those primary benefits that you'll see more often than not is a credit card is going to have what is called an annual percentage rate, or an APR. So APR. And let's say both Tim and Bob are applying for the same credit card, this $300 credit card. And the bank is going to look at Bob, and it's going to look at Tim, and it's going to say, okay, well, we can give Bob an annual percentage rate of 24.2%. For Bob here, Bob gets a 24.2% annual percentage rate, and this is essentially interest. APR and interest are used interchangeably, and that's not necessarily how they should be looked at, but in terms of credit cards specifically, it's close enough. So Bob gets an APR of 24.2%, but the bank looks at Tim, and the bank says, okay, Tim is a better creditor, or a creditee. Tim is better with credit. So because Tim is better with credit and we trust him more, and he's less risky for us, we can give Tim an APR of 22%. And that makes a big difference when, if you have debt, right? So debt is just essentially money that you owe that you did not pay at the end of the month, right? That's where debt comes from. So let's say Bob uses all $300 on this credit card. He uses all $300, but he's only able to pay $250 back by the end of the month, right? So that means he now has a $50 outstanding balance, and that is when APR comes in, okay? So APR is going to apply to any outstanding balance you have on your card, and every month that balance is going to accrue an APR of 24.2%. So that $50, right? That $50 that Bob now owes because Tim has a better credit score, it would only increase by 22%. And these are just, example numbers. They can vary wildly, right? A lot of credit cards, you'll see variable APR. A lot of it gets very, very complicated, but just, to give you an example of what's going on here, right? If you have a lower credit score, you're probably going to be paying a higher APR. Now, for more examples, we will clear the board here for just a moment. Banks and other creditors want you in their system, okay? Because credit cards make a lot of money. A lot of money. And, there's discussions to be had about the ethics and whatnot of the whole system, but again, not here for that. But banks, because they want you in their system, they want you using their bank, and credit card companies want you using their credit cards. There will often be a lot of incentives for different cards. Now, I'm not going to go over all of the different cards that are out there. There are innumerable credit card offers, and I'm sure you've gotten some in your mail before. But let's say, for instance, we have credit card A right here. This is credit card A, and over here we have credit card B. Now, let's say both of these credit cards are from different credit card companies. What they will do is they will go to the bank and they will say to the bank, "Hi, Mr. Bank, we'd like you to use our credit cards when, issuing lines of credit because they make a lot of money." And the bank will say, "Okay, well, we can do that. What do you have in mind?" And the credit card companies will go, "Okay, well, credit card A, let's say, wants to offer 1% cash back. 1% cash back on all purchases." Let me fix that a little bit. 1% cash back on all purchases. And credit card B says, "Okay, I see that company is offering 1% cash back on all purchases. What if I specialize? What if I go and I say, I'll give you 5% cash back on air travel?" So 5% cash back on air travel. And now they have to compete in the open market. And let's say Bob here takes a lot of vacations. Okay, Bob is a younger man. He wants to go and see the world a little bit. Bob will go to the bank or other credit unions, and he'll say, I'm looking for a new line of credit that gives me the best bang for my buck." This is where the bank will come in, and they'll say, "Well, we have credit card A that gives you 1% cash back on all purchases, or we have credit card B that gives you 5% cash back on air travel specifically." Bob may be more likely to go in the direction of credit card B. So this can get even more nuts when you have annual fees, right? So let's say both of these are just, free credit cards that you can just apply for. And you don't have to pay a monthly fee to have access to this credit card. These are just, starter cards or whatever. But when you get some of these more ludicrous credit cards out there, because again, it is an insanely competitive market, okay? Credit card companies are essentially doing war with each other. They want to have more people using their cards. So let's say, for instance, Tim is back. Tim has done really well for himself. He's amassed a decent chunk of cash, and he now wants to get into a more premium credit card, right? So this is Tim. Tim is back, and Tim goes to the bank or the credit union or whoever to open a line of credit, and he's looking specifically at a more premium credit card. So let's say, in our new example, we have over here credit card A and credit card B. And for the purposes of this example, we'll say credit card A has a $95 monthly fee. $95 a month fee. And let's say credit card B is a little more expensive. We'll say credit card B has an annual monthly fee of $115 a month. But credit card A, we'll say, has a signing bonus. We'll say that if you sign on for this card, you get 3 months of 0% APR. So 3 months of 0% APR just for signing up. Let's also say that credit card A offers 3% cash back on gas and groceries. And we'll also say that credit card A gives you 2 times points. So 2 times points. A little crowded here. We'll just say it gives you 2 times points on all purchases. Okay. And then we'll look at credit card B here and we'll say, okay, well, you don't get 3 months of 0% APR, but if you sign up for our credit card, we will give you 75,000 miles. 75,000 miles for travel that you can use wherever. 75,000 miles. And we'll also say that credit card B gives you a flat 2.5% cashback on all purchases. And we'll also say that credit card B gives you access to airport lounges. So, lounge access. At participating airports. And we'll also say that credit card B gives you 3x points as a truck passes by. 3x points on hotels. And I apologize that it's a little cramped, but just for example purposes, obviously. Now, these two card companies are competing with one another to get Tim as a customer. And when you're looking at these competing offers, you may say, oh, well, this is a little more expensive, but I get, more of what I'm looking for. Maybe I'm really attracted by this, 3 months of 0 APR, and it gives me a little bit of leeway if I get into any trouble financially, sort of thing. So this is how credit card companies sell themselves as products. This is how they attract customers, and they try to get people into their systems. And what you'll see a lot of the times is, depending on company B or company A, will say that company B has another credit card that's better than this one right here. We'll call this let's just call it the fast card. Okay, we'll call this the fast card for travel, right? The fast card from company B. But company B also offers another credit card that offers more rewards, and we'll call that down here. We'll draw a nice credit card. This is the same company, but this is the the swag card. We'll call this the swag card. The swag card. The swag card, we'll say, is $250 a month. And it gives you even more bonuses. It gives you 150,000 miles. 150,000 miles for travel. You get a free hotel every 3 months. Every 3 months you get a free hotel. Let's say you earn 4 times miles with this credit card. If you're making purchases with this credit card, you get 4 times the amount of miles that you would normally get. But the only way to be accessible, the only way to qualify for this card is to have been with this card. Okay, so this is another thing that credit card companies do, is they lock the better rewards behind previous cards. So let's say company B offers you the fast card. You can't just go in, you can't just go to the bank and say, I'd like to apply for the swag card. In some instances, maybe you can if you have, monetary connections, if you know what I mean. But for the average Joe just going in, they'll say, okay, well, we can't put you on the swag card because, you're not a customer, right? We need to start with the fast card. And they say, well, I don't really want the fast card. I want, this and whatnot. It gets super complicated there, but the company will say, well, we can't put you on the swag card. You have to have the fast card for 3 months or whatever, and then you can roll the points over into either system. And points are just one of these rewards that companies offer you for using their cards. Okay, so basically, if you're buying things, if you're spending money using their card, they'll say, okay, thank you for using our card. Here's rewards that you can claim for later. And these rewards can be all kinds of things, from gift cards to hotel stays, air travel, concert tickets, all kinds of things. There are rumors that at the upper echelon of credit cards that certain companies will even have a personal concierge that you can call if you have their super high tier, high class, millionaire card. You'll have a personal concierge that you can call and have them do favors for you and find things for you and all that. But I'm never gonna have a card like that, so that's just out of the question. But this is essentially how credit cards work. It is a system that is built on borrowing, and there are ways, of course, that you can use that system to your advantage, but there are also ways that that system can be used against you if you are to fall behind for any reason, right? So I hope that has given you at least a better understanding of credit cards, because where I'm at right now, and I probably shouldn't say this on video because I'm gonna get flooded in my email, I have no doubt. But where I'm at right now, I'm in a position where I'm looking to start building more of my own personal financial future, just because I'm getting older and there are bigger expenditures that are coming up, and all that kind of thing personally, that I want to have a good system set up for that, to have a little bit of financial freedom going forward. So I hope this was educational for you. Again, this is not financial advice. This is just me sharing my own research. There may have been bits and pieces that I sort of explained poorly. I know I'm not the number one advocate for any of this kind of stuff. This is just my own, personal research that I've been doing. But I hope you have learned something today. I thank you very much for watching, and I hope to speak